want to ask you something, and I want you to be completely honest with me. How long have you been working on this race? 6 months? A year? Maybe longer? And you've been doing everything right. You have the thesis, you have the track record, you're taking meetings, you're building relationships, and you're even following up. And still, the capital isn't moving. The wires aren't coming. The commitments keep sliding. So here's what nobody in this industry is going to say to your face. The conventional fundraising playbook, that 18-month institutional grind, the committee cycles, relationship building marathon, it was not designed to make you go fast. It was designed by people who benefit from it taking a very long time. And then there's the other version of this story, the one I see at every conference, every LP event, every invite-only dinner. It's the fun tourist. You know who I'm talking about, standing in front of somebody else's jet or Ferrari or yacht just to get the grand picture, getting a photo next to someone else's yacht at a capital conference, just as if proximity to wealth is the same thing as closing capital, collecting business cards from people who will never wire you a single dollar, flying to events to be seen rather than to do business. So let me be very clear about something. LPs, they see right through it immediately. They can tell the difference between a fund manager and a fund tourist faster than you can hand them your pitch deck. One of them is running a business. The other one is cosplaying as someone who runs a business. See, events are fun. I'm not saying don't go. But if your capital raising strategy is built around showing up at conferences and hoping someone with a checkbook notices you, that's not a strategy, my friends. That's an expensive networking with a prayer attached to it. So here's the thing about time. Time doesn't just kill your patience. Time kills your deals. The LP who was hot on your thesis in January is renewing 12 other opportunities by March. That market window that made your strategy compelling in Q1 looks way different by Q3. The momentum from early conversations completely evaporates when you disappear into the follow-up graveyard. Every day you're not closed is a day someone else is getting closer to taking that money. So what if I told you that there is a specific step-by-step playbook to raise $100 million in 90 days, and that it requires 0 yacht photos, 0 conference prayers, and 0 of the conventional wisdom that keeps you grinding? That's what this episode is. 5 moves. Let's execute. But really important, everything I say and share today is for educational purposes only. It's not investment, legal, or financial advice. Fundraising is a very regulated activity. What works for your fund depends on your specific structure, exemption type, and jurisdiction. So you want to make sure you work with securities attorneys before ever implementing anything you hear in this episode. So the full disclaimer is in the download below. So now let's jump in. 5 moves, all unconventional, all verified, all executable. So let's dive in. Move number 1, it's what I call the regulatory unlock. See, in March 2025, the SEC issued guidance that may expand how private fund managers can reach accredited investors. See, most managers have never heard of it. Next is move 2. I call it the LP stack flip. Stop targeting institutional LPs first. Here's who actually moves fast, writes big checks, and says yes without a 24-month committee. Move 3 is what I call the SPV to fund conversion. It's how to use single deal vehicles to bulletproof, build momentum, and convert believers into fund investors before you ever formally launch. Then there's move 4. I call it the warehouse deal weapon. How a deal already in your pipeline becomes the most powerful marketing asset in your entire race, and how to weaponize it legally. And then there's the final move, move 5, the FOMO Close architecture. It's the exact structure that creates real urgency, fills your first close on a date that you set, and makes slow LPs to move fast. So there's starter moves and pro moves on every single one. And see, I've been inside these conversations where institutional capital actually moves. So what I'm giving you today is built on verifiable data, documented case studies, and the specific regulatory changes of 2025 that fundamentally rewrote the rules of this game. So nobody is synthesizing these together the way that I am about to do it for you right now. So by the end of this episode, you will have a complete executable blueprint for a 90-day raise, not a framework, not inspiration, an actual playbook you can start executing this week with your fund, your network, and the frameworks and regulatory guidance available right now. So let's jump in. So let's jump into the first one. It's what I call the regulatory unlock. So I want to give you the most important piece of regulatory intelligence that most fund managers in 2026 either don't know about or haven't operationalized yet. And once I explain it, you're going to understand why it's the biggest unlock for the speed of your raise. So on March 12th in 2025, the SEC's Division of Corporate Finance issued a no-action letter that fundamentally changed how accredited investor verification works under Rule 506C under Regulation D. See, most fund managers missed it. The ones that didn't are already using it to raise faster than their competition has ever seen. And there's really two main private placement paths to raise fund capital in the United States. 506B, that's the traditional lane. You can raise from unlimited accredited investors plus up to 35 sophisticated non-accredited investors. But you cannot publicly advertise. You cannot post your fund on social media. You can't cold pitch strangers. You are legally restricted to people that you already have a pre-existing relationship with. This is why institutional fundraising takes so long. The law forces you to build the relationship before the ask. That's why I always say trust comes before the transaction. So you're building that relationship. Then there's the other side of that coin, which is a 506C. That's also under Regulation D. That is the broader path. So under 506C, with proper legal structuring, you may be able to publicly advertise. So that's the good news. You can start a business, you can advertise it. You can market on LinkedIn, YouTube, email, webinars, podcasts, press releases, digital campaigns, literally all of it. The catch was that you had to verify that every investor that comes into your show has an accredited status. And historically, by collecting W-2s, tax returns, bank statements, or professional verification letters. The administrative burden made most managers just avoid it entirely. But here's what changed in March 2025. The SEC issued guidance saying, if your minimum investment commitment is $200,000 for individual investors or $1 million for entities, and you obtain a written self-certification from the investor, that is reasonable verification for accreditation. You did not need their tax returns. You did not need a letter from their accountant. The check size itself, paired with a self-certification, clears the bar. So if you structure your fund with minimum commitments of $250,000 or above, which is entirely reasonable for a $100 million fund, depending on your structure, you may be able to publicly market your fund to every accredited investor in the United States. Does that sound pretty good? So LinkedIn posts, YouTube videos, email campaigns, podcast appearances, webinar funnels, conference presentations with a direct ask completely embedded. So you want to discuss this with your securities attorney just to confirm what applies to your specific situation. But think about what this means. Under your 506B, your raise was limited to the size of your personal Rolodex, right? Who can start a company and not advertise? To me, that's just the rich getting richer. Nothing wrong with that. Ain't no shame in that game. But there's an interesting one that allows other people who are really bright that may not have the network that other old money people have. And that's under 506C. With the new guidance, your market is every accredited investor who can find your content online. Just imagine that. A pool that numbers in the millions. Ray Dalio didn't build Bridgewater's LP base by waiting for introductions to find him. He published research. He shared ideas. He made himself impossible to ignore. Under the old rules, most fund managers couldn't do that with fundraising intent. But under the new 506C guidance and with proper legal counsel, you may have options you haven't explored yet. So now, before you fire up your Instagram and start posting about your fund, just wait a minute, stop. This still requires proper legal setup, a compliant PPM, blue sky filings in states where you're marketing, and a qualified securities attorney reviewing every public communication that you put out there. The freedom under 506C, it's real. The compliance obligations are equally real. So don't skip legal counsel on this. The SEC's anti-fraud provisions apply to everything you publish. So with that said, the door is open. Most of your competition doesn't even know it exists yet. And that's good news for you. So here's your starter move. Call your securities attorney this week and ask specifically, can we structure our fund under a 506C with a $250,000 minimum commitment? Just get a yes or a no on a specific structure. If yes, ask what compliance infrastructure you need before you can begin public marketing. This one conversation with the right attorney could open up options you didn't even know you had. And here's the pro move. Build a 506C compliant content marketing funnel. Create a monthly investor insight series. Educational content on your strategy and market thesis distributed through LinkedIn, email, and video. Every piece drives to a compliant investor interest form on your website. See, you're building a qualified pipeline of warm, self-selected, accredited investors who have already engaged with your thinking before your first conversation. So this is how you get to 90 days. You don't start the clock at zero. You start it with an audience leaning in. Now, let's talk about the second move, which is stop targeting the slowest money first. See, here is the strategic error that kills more fundraisers than almost anything else. Fund managers chasing institutional capital, pension funds, endowments, university foundations as their primary target from day one. So I do love institutions. I think it's a great way to go. In fact, I specialize that in Fundraise Capital, my community of capital raisers, where we talk about marketing and similar things that we're talking here. But institutional investors, they're not fast. And so if we're setting a goal to go from 0 to 100 million in 90 days, then maybe we do that as an add-on round. So let's dive in a little bit further. So I understand why these take a long time. The check sizes are massive and the validation is real. And getting, say, CalPERS on your cap table is career defining. But here's the operational reality that nobody's honest about. Institutional LPs have investment committee processes that run on quarterly cycles. They have consultants who need to vet you. They have boards who need to approve. They have fiduciary documentation requirements that take months to satisfy. Getting a first-time commitment from an institutional investor in under 12 months is exceptional. Getting it in 90 days from a cold start is almost impossible. And yet, there you are at the conference, in the networking dinner, trying to impress the pension fund allocator over shrimp cocktail, taking a photo outside the venue so your LinkedIn followers think you're cool and you're closing deals, whatever it is you're up to. But when you're actually eating shrimp cocktail and collecting business cards that are going to live in a drawer forever, LP cocktail hours are over and closing environments are up. They are relationship starting environments at best. If your 90-day plan depends on converting a conference encounter into a wire, I need you to hear me clearly. That is not a plan. That is a wish. Here is the LP stack flip. For a 90-day raise, you need to target the LPs who can move fast first, build momentum with their capital, and then use that social proof to bring in the institutional money on the back half or in subsequent closes. So tier one, move in days, high net worth individuals and family offices. See, these are accredited investors with personal liquidity, personal conviction, and no investment committee between their gut and their checkbook. A successful entrepreneur who made $30 million selling their company, a real estate developer who's been looking for a private equity vehicle to diversify, or even a family office principal who has sector knowledge in your strategy and just wants direct access. See, these people can take a decision in one meeting, sign documents in a week, and wire in 2. They are your day one targets. See, per global wealth data, high net worth individuals now allocate 15 and 30% of their portfolios to alternatives. That's great news for us. That allocation is growing every year. The pool of fast-moving, high-conviction alternatives, hungry for capital among high-net worth individuals in the United States alone is enormous. And most of them have never been approached by a fund manager directly because everyone is busy chasing the endowment or the pension fund. Then there's tier 2 investors who move in weeks. These are family offices with a chief investment officer structure, slightly more process-oriented than solo high-net worth individuals, but still nothing like an institutional committee. A family office with a dedicated chief investment officer and 3 to 5 person investment team, they can complete diligence in 3 to 4 weeks for the right opportunity, especially if you are in their sector. If they made their money in healthcare and you run a healthcare fund, the diligence is half as long because they already understand the market. That moves you to tier 3 investors who move in 60 to 90 days. These are small to mid foundations and endowments, smaller foundations, say 100 to 500 million in assets. They have less bureaucratic approval process than the mega institutions, and they have emerging manager programs designed to move faster. So that's a tip right there. And when I realized this, you can literally search emerging manager programs for pension funds or just emerging manager investment programs. Do a Google search on that and see what you come up with. See, those people, they have chief investment officers who can act with more discretion. These are your institutional credibility checks. And they can close in the back half of a 90-day window if you started the conversation early. Then the next tier is tier 4, and you want to build for fund 2. See, the mega institution pension funds, those are one of them. Large university endowments, sovereign wealth funds. These are your fund 2 story. So you build a relationship now, you show them fund 1 performance, and then you come back for fund 2 with a track record and a closed institutional grade fund behind you. See, chasing them for fund 1 is an energy drain that delays everything else. That flip means you start at tier 1, close fast, build momentum, use that momentum to accelerate to tier 2 and 3, and then position tier 4 as your next vintage story. You're not abandoning institutional capital. Please don't do that. But you are sequencing it intelligently instead of gambling your timeline on it. Another example is Ken Griffin at Citadel. He didn't wait for pension funds to validate him before he built Citadel. He built Citadel with high conviction private capital first. The pensions came after the track record existed. That is the sequence. So here's the starter move. Open Fintrix, Fintrx, or Advisor Pro, Advizor, and then Pro, Pro, or MyCRM, which is crm.fundraisecapital.co. You can go there, and out of any of those 3, you can run a filtered search for a single family office in your sector with AUM between 50 to 500 mil. See, these are the principals who allocate personally, move fast, and don't need a committee. And you want to build a target list of about 50 people. Research each one. What sector did they build their wealth in? What alternatives Have they backed before? And what is their entry point? This is your first 90-day contract list. And here's the pro move. Build what I call a sector gravity campaign. You want to identify the top 10 sectors where accredited high net worth individuals, where their wealth is concentrated, and it aligns with your fund's thesis. So healthcare, technology, real estate, energy, manufacturing, whatever. Then you build a content flywheel specifically addressing investment thesis for that sector. So when a healthcare entrepreneur reads your content about healthcare private equity dynamics, and it feels like you understand the world better than anyone, then you've already done 80% of the sales work before you've done the first call. So you can use Dakota, Fintrix, LinkedIn Sales Navigator in parallel to run outreach against that warm content audience simultaneously.
Hey, if you're finding value out of this discussion, could you do me a huge favor? Could you just take a second and hit that like or subscribe button? It costs you nothing, but it tells the algorithm that this is valuable information, and it helps us to get it to more people. Thank you. You're incredible. Now let's get back to the show.
That brings us to move 3. You want to build the proof before you build the fund. See, here's the most powerful, unconventional move in this entire playbook. And it's the one most emerging managers have never considered as a deliberate strategy. See, before you formally launch your fund, before the LPA is finalized, before the PPM is out, before your first close date, you want to run 1 or 2 SPVs, or special purpose vehicles. They're just single deal investment vehicles that pool capital from multiple investors into one specific opportunity. And here's why this is a 90-day rocket fuel, not a detour. An SPV can be formed in days using platforms like Carta, Allocations, or AngelList. Formation costs are approximately $5 to $15K. You identify a compelling deal, a real investment, and you want to make it part of your core strategy. So you bring 10 to 20 investors at 50 to 250,000 each. They see your sourcing, your due diligence, your deal structure, and your communication. They experience what it feels like to be in business with you. And then when you come back 3 months later with your formal fund, they're not strangers evaluating you on paper. They are investors who've already been on the inside of your engine, and they've seen the deal from the engine room itself. They've received your updates. They trust your process because they are living it. Think of it like this. An SPV is like giving a restaurant customer a private tasting menu before ever asking them to buy dinner membership. You're not asking them to commit to 10 years of an LP relationship just based on a pitch deck. You're showing them the food list. The LP who invested $100K in your SPV and watched you execute cleanly is dramatically more likely to write you $1 million check into your fund than any prospect you've been emailing for 6 months. Now, here's the power move inside this strategy. Structure your SPV with the right investors deliberately. Don't just take anyone with a checkbook. Bring 3 to 5 investors who have wide networks in your target LP universe. Operators, family office, principals, sector executives. When they back you in an SPV, and you execute well, they become natural evangelists for the fundraise. They introduce you to their peers. They confirm your credibility from firsthand experience. This is how first-time managers get warm introductions that feel earned rather than manufactured. Can you see the difference? Not from conference name drops, not from borrowed credibility, from actual delivered performance that someone they trust personally experienced. And here's the starter move here. Identify one deal you could close on in the next 60 days within your core investment strategy. Structure it as an SPV on Carta or in the CRM that we talked about, or any of those allocations. The platforms handle formation, cap table management, tax filing, and investor reporting. Set a minimum investment of $50,000. Bring in 5 to 10 investors from your immediate network who you want as future fund LPs. Then execute cleanly. Report clearly. This SPV is not just an investment. It is your fund's most powerful marketing document. And here's a pro move. Run 2 to 3 sequential SPVs over a 6-month period before your fund launch. Each one should bring in different LP personas. One focus on high net worth individuals in your sector, maybe one targeting family office principals, and maybe a third targeting smaller foundations. See, by the time you launch the fund, you'll have a portfolio and deal proof, a cohort of experienced investors who've worked with you, and warm conversations in a pipeline of 30 to 50 people who've already said yes to you, just in a smaller context. So your fund launch is not a cold open. It's a warm invitation to people who already know what you're building. That brings us to move number 4, which is turning your pipeline into your pitch. So I want to talk about the most underused asset in a fund manager's capital raising arsenal. See, most managers treat their deal pipeline as something that happens after the fund closes. You raise the capital, then you deploy it. But here's the move that compresses the timeline dramatically and solves the chicken and the egg problem that kills most first-time fund managers when they raise. Warehousing. A warehouse investment is a deal you close or commit to closing before your fund formally launches. So you source it, you structure it, close it using your own capital or a bridge structure, and then transfer it into the fund once that fund closes. That deal now lives in the fund as a day one portfolio company. So your LPs are not committing to a blind pool and then hoping. They're committing to a fund that already has real investment in it. And here is what this does to an LP's psychology. So when a fund manager shows up with a thesis and a deck, the LP is evaluating potential. When a fund manager shows up with a thesis and a deck and a live investment already in the portfolio, the LP is evaluating execution. That is a completely different conversation. The risk profile drops, the decision timeline compresses, the I need to see you operate for another year before I commit objection completely disappears. And it's because you've already operated. See, some warehousing is done with the fund manager's own capital. Some is done through working capital facilities, specifically designed for emerging managers. See, mission-driven finance runs such a facility, and similar products exist in the market. Some is done through the SPV structure I just described, and the mechanism matters less than the principle. Arrive at your LP meeting with skin in the game and a live asset deal to discuss. See, think about what David Swenson did at Yale. He only backed managers who had demonstrated they could execute, not just theorize. See, warehousing gives you a demonstrable execution before your fund even formally opens. You are showing them the deal before you ask for the checkbook. And here's the secondary weapon inside warehousing that almost nobody talks about. So when you are in LP conversations and you reference a deal you're currently working, say one that is live, active, and time sensitive, you have created a natural urgency. I have a deal in diligence right now that fits this thesis perfectly. I expect to close it inside 45 days. LPs who are in the fund by that date, they get to participate. LPs who are not, don't. That is not manufactured pressure. That is honest reality of how private investment works. Capital calls follow deal timelines. The deal doesn't wait for LPs who are still in committee purgatory. This is the commercial truth that changes the posture of every LP conversation. And it moves it from whenever you're ready to there's a ticking clock. And here is the starter move. So identify one investment you can source and commit to within the next 30 days using personal capital or a small SPV. Even a $250,000, a $500K position that fits your thesis is sufficient. See, this becomes your proof of concept, your live exhibit A in every LP conversation. It can go something like, here is a deal one. It's already in the portfolio. Let me walk you through the diligence. Then the fundraise conversation just got 60% more credible. And here's the pro move. You work with fund formation attorneys to set up a formal warehousing structure before your fund launch. Establish clear transfer mechanics. At what valuation does the deal transfer into the fund? What are the LP protections? How is the cost basis handled? Present this structure to your LPs in your PPM as a feature, not a footnote. We currently have 2 warehouse investments that will transfer into the fund at its first close. It's one of the strongest opening lines in a fund's pitch, and almost nobody is using it. Everything in this playbook has been building to this very moment. You have the regulatory lane open. You have the right LPs targeted. You have proof in the form of SPV execution and warehouse deals. Now we talk about the close architecture, the specific structure that turns a warm pipeline into a wired capital inside 90 days. Let me dispel a myth first, though. Urgency in fundraising is not manipulation. It's a commercial reality. Private fund investments have real windows. Capital calls follow deal timelines. A first close at 40% of target unlocks the investment period. Founders' class terms, they expire. These are not artificial. They're structural features of how investment funds work. The problem is that most fund managers are either too apologetic about them, or they soften the deadline, they extend the close, they accommodate every LP who asks for more time. And every time you extend the close date for a slow LP, you send the signal to every other LP in your pipeline. This manager moves when I say move, not when the strategy says move. That is the wrong signal. That can kill your momentum. So here are the 5 elements of the FOMO Close architecture. These are not tricks. They are the structural design of a fundraise that commands respect and creates real, legitimate urgency. So the first element is the founder's class share. Offer preferential economics to your first close LPs. It's say a 10 to 50 basis point reduction in the management fee. Then you can enhance co-investment rights, an LPAC seat. These are all terms that are available to investors who close before your stated first close date. They expire on that date, and you hold the line. The Founders Class shares are not about discounting your fund. They're about rewarding the investors who had the conviction to move early. And then when LP3 hears that LP1 and 2 have Founder Class economics that they will never be offered again, that decision calculus starts to change. Then there's the second element to this, which I call the scarcity signal. Your fund has a target size. Your first close has an allocation ceiling. And when the 60 to 70% of the first close is spoken for, you say explicitly, we have $42 million in soft commitments against a $60 million first close target. We have $18 million of allocation remaining at Founders Class share terms. That's not a boast. That's a scoreboard. Investors respond to scoreboards. Nobody wants to be the last one in after the good terms are gone. And then that's the third element, which is what we call the deal clock. So as I described in Move 4, a warehouse deal or active pipeline opportunity creates a legitimate time constraint. This deal is closing in 45 days. Fund investors participate, non-fund investors don't. That's the message you get to send. And you're not creating pressure from nothing. Please don't do that. That's going to ruin your reputation. This deal itself is the pressure. You are just being honest about it, and they can pick up on it. That brings us to the fourth element, which is the hard close date, and you hold it. Set a first close date, put it in writing in every LP communication. And when the date arrives, close. Even if you're 30% of the target, even if 3 LPs are still in diligence, a first close at $30 million on a $100 million fund signals this manager executes. This manager does what he says. This manager is not waiting for permission. Those 3 LPs in diligence will move significantly faster to your second close than they would ever have moved to your first. One of the most important pieces of legal counsel you will ever receive in your fund, most likely, is do not set a close date that you cannot hold. See, attorneys advise this because missing a stated close date is a credibility wound that is very hard to recover from. So set a date you'll hit, then hit it. That brings us to element 5, which I call the public momentum signal. See, now under a 506c structure, you can, with proper legal review, communicate publicly about fund progress. A LinkedIn post that says, we closed our first tranche of investors. They're now in. Thank you to our founding limited partners. This is a public social proof signal. Every LP who's been on the fence just saw the other people move. That, my friends, is momentum made visible. And here's the metaphor that ties all 5 moves together. So think about a concert that sells out fast. The reason it sold out fast wasn't that the music was suddenly better. It's that someone bought a ticket, posted about it, and suddenly everybody who was on the fence about going, they realized the window was closing. That's what we call the FOMO Close architecture. It's the ticket selling system for your fund. The music, your strategy, is already great. Now you need the ticket system to reflect that quality with the appropriate urgency. And here's the starter move. So you can set your close date right now. Write it down. Tell your next 5 LP conversations the specific date. Offer founder class terms that expire on that date. Even a modest 25 basis point fee reduction is enough to create preference for early action. And you want to hold the line on that date. You will be amazed at how quickly conversations that were moving at LP speed suddenly shift to normal human speed when there's a real deadline in the room. And here's the pro move. Build your complete FOMO Close architecture before you even start LP conversations. Founder class terms that are shared in your LPA right from the formation. You want to have a soft circle tracker that's visible to your GP team, updating in real time, and a templated momentum update email that goes out to your full pipeline every 2 weeks showing allocation filled, allocation remaining, and days until close. That is your scoreboard communication on a system, and it runs automatically and creates urgency without a single pressure phone call. That brings us to the 5th move, the honest math. So before I give you the action plan, I want to give you the honest math, because 100 million in 90 days is a specific claim that you deserve to understand exactly what it requires. A $100 million fund with $250,000 minimum commitments needs 400 LPs at minimum average, or far fewer LPs at larger average check sizes. Realistically, a 90-day close at 100 million typically involves 20 to 50 LPs writing checks of 2 million to 5 million on average. That means you need a qualified pipeline of 150 to 250 serious prospects to generate 20 to 50 closes. The 5 moves in this episode are how you build that pipeline at compressed speed using public marketing under 506c. SPV proof, warehouse deal urgency, the right LP targeting sequence, and a close architecture that commands action. Now, is it possible for every manager? No. It requires a credible track record, a differentiated thesis, operational readiness, and a compliant legal structure, and the discipline to execute every single element. But it is achievable for a fund manager who does the work, sequences the moves correctly, and builds a system instead of chasing a prayer. Absolutely. And the managers who get there in 90 days, they're not smarter than you. They're just more systematic in their execution. So that brings us to the 5 moves. Let me give you the complete picture in 30 seconds. Move 1, the regulatory unlock, 506C, plus the new 2025 SEC guidance gives you public marketing lane that most of your competition, they haven't even discovered it yet. Move number 2 is the LP stack flip. Target high net worth individuals and family office capital first. Close fast, build social proof, and use that momentum to bring institutional capital into subsequent closes. Then there's move 3, the SPV to fund conversion. Run proof of concept deals before the fund launches. Convert SPV investors into fund investors with trust already built. Then there's move number 4, the warehouse deal weapon. Arrive at LP conversations with a live deal in your portfolio. Proof of execution beats projections and a pitch deck every time. And then move number 5, the FOMO Close architecture. Founders class terms, a hard close date, deal timing urgency, and public momentum signals. Real urgency, real close. So stop being a tourist, build the system, execute the close, and close the fund. So here's your next move. Click the link in the description right now. I've built you the 90-day, $100 million raise blueprint, the complete field manual with 506C compliance checklist, exactly what your attorney needs to set up this structure correctly, the LP stack targeting worksheet, Fintrix, Advisor Pro, and Dakota search parameters mapped to each LP tier. The SPV launch protocol, step-by-step from deal identification to investor close using Carta or allocations. The warehousing structure template on how to document pre-fund deals for LP presentations, and the FOMO Close architecture calendar, week by week from day 1 through day 90, with every momentum touchpoint mapped. This is the complete system, not the highlights, the whole thing. And if this episode made you look at your current raise and think, I've been playing the wrong game, then share it. Tag the fund manager in your network who is 2 years into a difficult raise that should have closed in 4 months. You might change the trajectory of their entire business. So stop acting like a fund tourist and start closing like the fund titans you are. You do these things and you too will be well on your way in your pursuit of making billions.